Hey guys, thank you for joining us. It's XTB's goal to make your money work for you. So today we're going to be looking at investing goals. And today we have on with us Kathleen Brooks.
Hi, Kwabena. Thanks for having me on.
No
I'm
problem.
Kathleen. I am the Research Director in London at XTB.
Brilliant. And Kathleen, we're going to talk through some key investing topics and help people achieve their investing goals for 2025.
Yeah.
So the first question I have for you is that what should people ask themselves before investing?
I think there's a few key questions you need to ask yourself. So it's great that you've got to the point where you're thinking about it, because that means you're thinking about your future and a secure financial footing for your future. That's great. First thing, you need to be really honest with yourself. How much money do you have to invest? So you have to look at it holistically. How much do you need to spend on your necessities? And then how much can you invest? Because investing isn't just a one-off. It would be great, the way that you build your investment pot, your financial gains, is to invest consistently over time. So how much can you do that over time? Rather than put everything in straight at once, it's sometimes worth looking at it on a really long-term trajectory. So how much have you got? The second thing is, how much time do you have to devote to this? That's really, really critical, because if you've got lots and lots of time and lots of knowledge, then you might invest very differently to someone who is time poor and doesn't have as much knowledge. And secondly, you've got to look, how much do you actually know about this?
Yeah.
Do you know everything, a bit, or nothing?
Yeah.
And if you know nothing, always underestimate your knowledge, because financial markets, they're a big beast. They've got big tentacles. They go into lots of different things. So you have to keep on top of a lot of things. But asking yourself all those questions will help you get to a place whereby you can ensure that you're in a secure financing environment. And that's what we all want. We want to make sure that we're putting our money in the best way possible. We're trying to make it grow and get returns. And we're also going to be comfortable with that investment. That's really, really key.
Brilliant. And you know, it's 2025 just hit.
Yeah.
A lot of people are making goals for their investing.
Yeah.
Either they want to start investing in an ISA or just get better and hit their goals in investing.
Yeah.
How should people go about determining what those goals look like?
I think it's really interesting, because you sometimes look at articles, you might look at certain asset classes as well, and you think, great, I can make 100%, I can make 200%. That's very unrealistic. So if you look back over the very long haul of investing, let's say 40, 50 years, then that will give you a more realistic idea of what you should be aiming for in a year in terms of your returns. So I always think make annual returns rather than monthly or shorter term returns, because markets are volatile. As you know, Kwabena, they go up and down. So we want to look over the longer term, because then you see a more flat sign of how markets have performed, rather than you miss out all of these choppy markets. So look through the long term. So a year, maybe 2 years is a good investment horizon. And you can just turn around and see, well, how have other benchmarks performed in that period? Now, when we talk about benchmarks, we often talk about major indices. You might be looking at the S&P 500. However, that's very concentrated in tech stocks. It's really worth remembering that. They had a great year in 2024. They may not perform the same way in 2025. That could be the FTSE 100. If you're based here in the UK, you might use that as a benchmark. And that will be that benchmark, you're looking to maybe match the performance of the FTSE 100 or even potentially exceed it. Now, the FTSE 100 made about 5% last year. It was a real laggard compared to the S&P 500 in the US, which made over 20%. So somewhere in the middle of those two is where maybe something where you'd like to look at. But certainly have a benchmark and try to reach that high. I always think that's a good way to look at it, because that will tell you a really what's realistic in the market, because the FTSE 100 is 100 of the top biggest UK stocks. If you're aiming for the same performance as that, then you're probably aiming for the right economic conditions for your investment.
And obviously you're talking about benchmarking against different indices.
Yeah.
How does somebody go about realistically setting those goals, those benchmarks? Are some too unrealistic for your investment horizon? How do you go about setting those realistic goals?
So I think you need to break it down further. So it's like, what do you want to invest in? So if you want to invest in a slightly riskier strategy, which might involve individual stocks, then to go about setting those goals, you've got to look at that company. How has that company performed in the last year? Go back over, do searches, go find their reports. How much have they earned how much money have they made? How much profit have they made in the last year on a quarterly basis, few years even? You then want to say, well, how has their stock performed in the last few years? So that will then give you a realistic goal if you want to trade that stock. Now, if you want to trade an index, for example, an equity index, that's a less risky strategy in some ways because it is a bit more diversified than just an individual stock. So you'd go back, again, see how well that's done over the last year and then base your goal on that. But actually looking to start with on your goals, what this shows you is you need to decide what do you want to invest in. And do you want to go through an individual stock route or would you prefer ETFs? Do you want to invest in the whole index or are there just certain sectors that you're more comfortable with?
That's brilliant. And obviously with setting those goals, a lot of people are looking for success in investing. What would you say success looks like to an individual starting in investing?
Well, firstly, it doesn't always look like you want it to look.
Yeah.
Secondly, it's not always in your control because big control, if you've got a diversified portfolio of investments, then you may have multiple companies in there who trade around the world, who are based in different locations.
Yeah.
So you can't control how they're going to perform. There's going to be company level risk, so how they're performing on a quarterly and annual basis. You're also going to have just overall market level risk. Geopolitical risk will impact all of that. So you've got to be really realistic. And I think what you have to do is always be flexible.
Yeah.
So rather than go in and say, well, this year I want to make 20% return. Start small. Obviously, you always want to make your money, but you've also got to remember that your investments can sometimes need to ride out storms that you can't understand. There could be a war that pops up. There could be another geopolitical event that absolutely seems to blow up your investment strategy one month. Look through it. Stay invested. That is often the key that you have to do. So in terms of making your goals, making sure they're realistic, but staying invested is actually the best goal you can have because then you're not missing out on opportunities down the road.
And you talked about staying invested. Yeah. How do you stay consistent then in investing?
So I think an easy strategy to do for this is having some investing habits that go on. So rather than just invest as a one-off, why not setting up something so that you're investing monthly? Even if that means you put less in each month, you're looking at it cumulatively over a year, over 2 years. So you're building up your pot that way. So that's the first thing that I think, just a habit of investing consistently. Because if you've got your good investing habit of putting your money aside to try and grow it, to have a secure financial future every single month, then that will lead to consistency. And consistency, we all know it, whatever we're talking about, leads to results.
Yeah. And obviously you've had a lot of experience in the markets and investing. How do people best get started in investing?
Well, I think the first thing to remember is you need to know what you can control and what you can't control. So you control what investments you choose, whether or not you want a high risk or a lower risk strategy. The second thing you can control is how much do you want to put in that investment. Obviously, you don't want to put all your eggs in one basket or put all of your free cash flow into investing. You may need to make sure that you've got some money, a rainy day fund, keep that there. But for your other investments, you want to just remember that if you continually look at your investment portfolio multiple times a day, once a day, then you will become a very stressed individual because they are moving alongside the markets. The best thing to do is to invest consistently. So put money in every single month into your investments. You can move those around if you want. The second thing is to just check on them once a month. Look through the periods of volatility. Now, we have I've been in the markets for over 20 years. I've seen the very end of the dot-com bubble. I've seen the 2008 financial crisis, COVID as well. There have been some huge swings in markets, and I can tell you from experience, the worst thing you can do is look at your portfolio when you're in the middle of that, because all of a sudden you're going to be really, really worried. And actually, if you leave it a month, it's not as bad. The other piece of advice I would give is you've got to make sure that you read around your topic. So keep on top of what's going on. Now, if you're investing for the long term, you might choose to invest in ETFs rather than shorter term investments. When you do that, the benefit of doing that is it gives you peace of mind. You don't need to be as on top of everything as you do. You don't need to be trading like a professional. So trade like the amateur that you are, or whatever level you think you are. Trade like that. Don't try and trade like somebody else. Stay to your own lane. I also think that you need to just remember that in the periods where it really has looked like markets are just falling precipitously and things are going to get, blow up. That's often the best buying opportunity. So markets bounce back from those periods of extreme volatility, when we see big losses, that tends to be the foundation for something new to happen again. If you look at a long-term chart of equity markets, by and large, they move higher. So stay invested. And I'm talking over decades, not over days or months, but over decades, they move higher. So that's why you should stay invested.
How would an investor use market data analysis in their investing strategy?
So I think there's two ways. The first one is to make sure you always have an overview of what's going on. So in that sense, you'd look at the daily notes that are produced on the XTB market analysis page. Keep yourself up to date with those. If you like specific analysts, maybe subscribe so that you get their daily note that will tell you what's going on, how things are performing. Also ensure that you read their annual outlooks, their quarterly outlooks, because they can give you a slightly long-term picture. But I think the other thing to point out is just keep aware of, for example, if you're really into a sport or something, you might read around that, you might watch TV about that. Do the same with your financial investments. So treat it's a bit like a hobby in some ways, but apply the same principles to it so that you are reading around the topic, you're watching videos that are being sent out, so that you just know what's going on. And then what you often find is that financial markets tend to be quite circular and cyclical. So, the same data releases happen every single month, and they can have big impacts on financial markets. They can help you understand, well, which economy is doing well, which isn't doing well. That might help you inform a decision if you want to make a change to some of your investments. The good thing about investing consistently is you might start with a bit of a diversified portfolio of, say, 3 or 4, let's say ETFs in this case. You might look at the US, you might look at the UK, you might look at a commodity, or you may look at none of those things. The good thing is you've got those as your base. Maybe the next month you want to add to those because they've been doing quite well, or you could maybe add in something else. Doing it slowly and consistently, month by month, I think builds up the best portfolio.
That's brilliant. And currently there seems to be a lot of economic news and trends happening right now. How should people prepare for such economic scenarios as an investor?
Yeah, so I think the thing to remember is that every so often things seem to change. So things can change on various levels. You can have geopolitical events. We saw that in 2022 when Russia invaded Ukraine. You can have political events. We saw that in 2022 again with the UK and the Liz Truss government and the impact on the bond market. You've seen that in 2024 and 2025 with Trump. Those things are geopolitical things, political developments as well. They can have an impact on markets. And then, of course, you've got economic data. So economic data is released generally on a monthly basis. So you get a real update on what's going on a monthly basis. That's a short-term data. So you don't necessarily react to that. Then you get quarterly data. That will give you GDP updates. So how's the economy performing in most of the countries in the world will report GDP on a quarterly basis. The other thing that you'll then get is looking at things kind of on an annual basis. So you're looking at, well, how are economies performing? Then the next level is what's the political backdrop? Is that pro or negative for an economy? Yeah. And then the next level you might look at is, well, what's the geopolitical situation like? Is there a geopolitical issue that's going to make this asset class vulnerable, or are they going to benefit from it? So that's how you kind of use your market analysis to build your portfolio. But that takes a lot of time. Yeah. So actually, to start with, a lot of people might choose to trade an ETF of a stock index, let's say the US, purely because it's the biggest market by far. So that's a market that some people know and that they might feel comfortable with. And then over time, by looking at all those different analysis pieces, by getting a bit more used to data, then that's how you build up your market knowledge. Don't just go roaring in because you read one article that said, buy this, buy that. That's a big mistake. Build it up over time and just be cautious, like you would with a sport. You don't go in saying, I want to play for that A team. You've got to start from the beginning. You've got to learn the techniques, and then you practice, and maybe you get to that A team.
I think you brought up a very good point at the end about finding some piece of data and going all in. How would you best advise people to find different pieces of information? Is it social media now that's a big trend, or maybe they need to subscribe to the Financial Times? What advice would you give to people for finding the right information to invest in?
Yeah, I mean, I think there's three things. There's the financial press, which has some really high quality analysis in there, and it has high quality business journalists. That could be the Financial Times, the Wall Street Journal, even the business section of other papers. Definitely worth always having a look at that every single day. The second level is investment platforms, investment banks as well. They have fantastic professional research teams. They will be looking at markets objectively and with a real eye for analysis and detail. So subscribe to those, try to get access to the research reports, and read as much of that as you can. And then the second thing, I wouldn't rule out social media, because there's actually, often if you look at some of the analysts that work for the investment platforms and the investment banks, they also are quite prolific on social media, and they can give you real insightful, short chunks of information. That's not necessarily something that you would trade on the back of, but it certainly helps create a puzzle that, it's an important piece of the puzzle that helps you or informs you to make better decisions of your choice when you want to boost your portfolio or increase your portfolio or even build it.
And what would you say the common mistakes are for people who are starting off in investing?
So I think there's one thing. I think spreading themselves too thinly. So trying to have an investment in everything, ETFs and individual stocks and FX and commodities. Often for a beginner, that's too much. It's better to narrow things down. Now that may sound like you're then less diversified. You're not necessarily, because you could be in an equity index, but yet you've got exposure to lots of different things, including FX, because companies will trade around the world and they'll benefit or not, as the case may be, from forex flows as well. Within that, you've often got energy companies, so that could give you some exposure to commodities as well. So rather than going really, really broad, sometimes it's better to just focus on one thing. That's one of the key things that I've seen beginners, myself included, back in the day. The second thing is to jump on the bandwagon. So you hear that everybody's making loads of money in a crypto or in a particular stock, and you think, oh, I want that. Often when you're hearing that, it's too late. The move has been and gone, and you can end up being the unfortunate person that piles in at the top as everyone's about to go. So we've seen a lot of that over recent years with things like meme stocks. Their value has just absolutely surged based on a couple of tweets. It's why you've got to be really careful with social media as well and only follow your trusted sources. Remember, this is your hard-earned money that you've probably paid tax on. You don't then want to lose it based on, something that you're FOMO, fear of missing out, because everybody else says they're making all this money. Another thing I would be really wary of when people say they're making really a lot of money on one weird stock that you might not have heard of, or one crypto coin that you've never heard of. I'd be really, really careful of that for sure. And I'd be really careful of thinking that you know everything about investing. So again, as I said, like starting slow, starting cautiously, and giving yourself time to read up and to learn over time. If you set an investment horizon and say, right, I want to invest consistently for at least the next year. If you're investing monthly and you're doing that, you've got that every single month. You can build on and on in terms of your knowledge, in terms of your experience, in terms of your confidence. And that really adds up. By the end of that year, I can guarantee you'll want to continue.
And lastly, just to wrap it all up, what advice would you give to new investors?
So again, I mentioned earlier about investing habits. That's really key. So get your habits in place first, because we know that's what creates a trend, and that's what creates success in the end. So your investing habits, as I said, investing consistently, just what you can afford. Also, building up your knowledge one step at a time. Don't bite off more than you can chew. Remember, you've got a life out there. Keep this as being something that's important to it, but also separate to it, so that you don't lose faith and lose motivation. So just set small goals, maybe a couple of articles a day, and just build on that. Second, and lastly, I think that you just need to be really, really careful. When you hear a lot of panic in the news about financial markets, look through it. Don't go checking on your account and thinking that you have to sell, because that's what everyone is doing. Actually, as I mentioned, that's often a foundation for the next leg of the rally. So don't be caught out by selling at the low or buying at the high.
Brilliant. Thank you very much for joining us, Kathleen. That was really insightful.
Thank you.